We had somebody on Squawk Box this morning suggest that Apple hasn't changed that much from $1 trillion to $2 trillion. So why has the stock gone as far as it had? The fundamentals haven't changed that to drive from $1 trillion to $2 trillion. You've had massive multiple expansion, and now you're at what could be an unsustainable level.
Scott, what changed is the fundamentals of the world around Apple. You now have a 10-year Treasury with it's 50 or 60 basis points. If inflation is, we think it's 2%, it could even be higher if we measured it differently. So in real terms, you're actually losing money on risk-free bonds, and that situation has exacerbated further over the last month. So that's what's really happened. And so it's not just an Apple story. That's what happened with every growth stock. If we're basically saying that, if we're looking at things like terminal rates and cost of capital and what the risk-free return is for something like a Treasury, and that number now goes negative in real terms, in inflation-adjusted terms, then arguably people that are doing modeling on what growth stocks are worth, well, they can just ratchet up all their price targets. And that is now, I think, getting to the point where it's crossing over into abject silliness. That's not to say that Apple doesn't deserve to be the most valuable company in the world, but this, forget Netflix, ExxonMobil's a $180 billion market cap. Should Apple add the equivalent of an ExxonMobil in market cap on a weekly basis? It's getting to the point where it's completely out of touch with the size of the economy and Apple's role in it, even globally. So that's not to say it can't go higher, because remember, they're still doing their capital return to shareholders. They're still buying back stock. I hope they slow down, but that's still part of the story here. And the cash generation of this company is still enormous, unlike anything that's ever been seen. You really have to go back and read about the South Seas Company and the Dutch East India Company to find anything this dominant. But these stories can't go on forever.
Rob, is this sustainable or not? And part of the reason I bring up what Strategas says about Apple's weight in terms of the S&P 500 is it better not falter. It better not have a single misstep, because then you risk having broader implications for the overall market.
Totally agree with that. I also agree with Josh and everybody that spent time speaking today. This is a story beyond Apple. If you look at the most virtual, the most digital, the most innovative companies, they are the ones that have been the winners, because investors are willing to pay up for that durability of growth. And I think that continues until we have a solution for the virus. And that may be some time, and there may be some volatility around those answers. It is concerning, though, because when you look at Facebook, Apple, Amazon, Microsoft, Alphabet, they're 22% of the market cap of the S&P 500. I think they've performed for very good reasons, but I think they may have gotten ahead of themselves, and I think that's what we're all talking about. But in a zero-return world where the 10-year is yielding 50 basis points, and you can get an earnings yield on the S&P 500 driven predominantly by these growth companies of 4.7%, depending on what your earnings are for 2021, it starts to look like the market may have been acting rationally, shunning these value stocks, favoring these growth stocks. It also looks like when you look at the earnings of the S&P, I mean, you have basically 80% of companies have reported, 18% have beat at the top line, bottom line, 3% have beat at the top line. Those are extraordinary numbers. And so markets are not, in my mind, acting irrationally, but I am cautious about the magnitude of the move that we've seen in some of these names and some of the disconnects that I see between the market and the real economy.
Shannon, NASDAQ's now gone negative. How do you see this playing out?
I agree with what everybody's been saying. I think that there are, two legitimate sides to this story. Number one, there is sustainable growth, and that factor continues to outperform if you're looking at it from a factor perspective. Number two, I think we were all afraid of this last week. We were anticipating the potential for one of these stocks to make a mistake and have a misstep, and we didn't see that, and everybody cheered that, and now it's continuing to pile back in. I do think that there is going to be an opportunity for investors who want to own these companies long term. I do think there's going to be an opportunity for them to get into those stocks. I think that it won't be valuations that upset this. I think it will be one of these stocks reporting something that does not fit where their multiples are right now. And so, I would be wary. I mean, if you had to press me on whether I would sell Microsoft now or hold it for 10 years, then I'm absolutely holding Microsoft for 10 years, even at these levels. But I think that when we look at the NASDAQ and we look at the overabundance of performance and outperformance of tech stocks over everything else in the market, I just don't think it speaks to the strength of the market overall. And I'd love to see the rest of the market catch up rather than see these fall and say, aha, I told you so.